I'm going to start with a simple question. So if we could have the question for the IML system.
Cool.
Up.
So get your phones out.
See if this thing works. Have you ever started a business? All right, now there's a few options there. You could be a current or past founder, CEO. You could be a corporate executive that's looking at being an intrapreneur, as they call it, so coming up with a new business line within an existing business. You could be looking to start a new business in the short term. Are you keen, but you've got no concrete plans? Are you open to possibilities? Is it something you would consider doing? Or would you just prefer to be employed, or have you got absolutely no idea what you want?
We'll give you 20 seconds starting now.
Is there a ticking?
Yes.
Yeah?
10. 7.
It's working well, isn't it?
4. There we go. We've closed it already.
Everyone voted?
There are your
Closed?
results, sir.
Aha. Oh, okay. So we've got quite a few people in the audience that are already running their own business, which is great, and a significant number open to possibilities. Perfect. So the majority of you are either doing it or would like to consider it. So let's have a really, really quick whistle-stop tour through what it's like to start a new business and what sort of decisions you have to make along the way. A quick definition for you. Innovation. We're talking about it. The name is in the title of the conference. What is innovation? My definition of innovation is very simple. It's invention plus adoption. You come up with something new in the most general sense, and you want people to adopt it in order that they then innovate. If all you do is invent, it's interesting, perhaps curious, maybe even amusing, but relatively useless unless people adopt it. And the way most people adopt things is to buy them. So my working definition as an entrepreneur of innovation is invention plus commercialisation. And the challenge, whenever you try to work through this process, is that the value proposition, that is the reason why people will buy what you've invented, not why you think they need it, and we'll come back to that, is never clear at the outset. It always changes as you go. So in inventing, you're turning money into intellectual property, commercialisation, intellectual property back into money, and you hope that the money at the end is greater than the money at the beginning, or it wasn't a particularly successful venture. That's the challenge. Why is it so difficult to create a value proposition? The reason it's difficult for most people, particularly those of you that might be in a technical or highly creative area of business, where you've come up with intellectual property which itself has been quite involved in its generation, you tend to get enamoured with your own invention. And your mindset starts in the position of, I'm sure the world needs this. There's this huge problem out there. I know I've got the solution. It's brilliant, it's elegant, and the world needs what I've done. And you think in terms of the features and the benefits, exactly how it's going to help someone do something. And this is very much left brain thinking. So when you think about it, the left brain of a value proposition covers your features and benefits, the business model, how you're going to sell it, how you're going to deliver it, how you're going to service and support it, what the return on investment of your business is going to be. This is all left brain thinking. Speaking as a scientist engineer from my early training, I used to be dominated by the left brain. In fact, I dismissed the right brain as completely and utterly irrelevant, and for softies and pansies, left brain is what it's all about. I'm solving a problem. But then there's the right brain. And why is the right brain important? Because it doesn't matter who you're selling to, whether it's the managing director of IBM or if it's a consumer in the street, you're selling to a person. And everybody's got a left brain and a right brain, and they use it, and they don't use it in ways they're prepared to admit. Everyone will tell you they make a purchasing decision based on their left brain, and everyone will be wrong. And let's have a look why. Because the right brain is what dominates your thinking when you're considering brand, when you're considering the credibility, reputation. You don't actually do an analysis of IBM every time you decide whether to buy a product from them. You know they're IBM. There's a reason why that saying, no one got sacked for buying IBM, exists, but it becomes myth unto itself. You personally haven't done the analysis. You're relying on a gut instinct that says it's okay to buy from IBM. And there's a lot of right brain in that decision that's got nothing to do with the product in front of you. Politics, feel-good factors. Does it save on carbon? Does it do this? Does it do that? There's all sorts of reasons why you might buy something. Basic emotions. Fear, greed. Greed's good, right? That's why I wore the suit. Inertia. Inertia is a great reason not to buy something. People, I often get present us with investment opportunities. They say, you know, we've got this fantastic invention. No one's solved this problem in the world today. It's the only player in the marketplace, no competitors whatsoever. I said, nope, you're wrong. They said, how do you know? You haven't even looked. I said, because you're ignoring one of the most powerful competitors there exists, and that is to do nothing. I don't have to buy what you're offering me. You need to convince me to buy what you're offering me. So the do nothing option is often your biggest competitor, not someone else trying to do the same thing. And finally, personal relationships. You just like the guy who's trying to sell to you, as if that never works. So the reality is that every single value proposition is necessarily a combination of left and right brain. If you don't address both in the way in which you construct your business, you will fail. So let's have a look at some examples. Here's a good left brain, right brain test. Okay. Holden Caprice, lovely saloon, automobile, leather interior, DVDs, you name it, it's got the option. And a Maybach, which is the upmarket version of a Mercedes, assuming the Mercedes itself is not an upmarket version. There's a couple of the features and benefits of each. You can see there's not a lot between them. I suppose on paper you'd probably go for the Caprice. It's 6-speed versus 5 speeds, better fuel economy. Let's go for the Caprice. And there's this little thing about price. So the Maybach's about 1.3 million, which is really a bargain. And the Caprice about 62,000. So explain to me...
What colour is yours, Doron? The Maybach.
Gunmetal grey. But if you had to explain to me why it is that anyone buys a Maybach, you then tell me that it's a left-brain decision. Then tell me that the people doing it are just pathetic, impressionable consumers. They're typically leading some of the biggest corporations in the world. They're nothing. They are certainly not pathetic. They would certainly not represent themselves as hopeless consumers, slave to brand and advertising, but they have just spent $1.3 million on a car. Think about that. I'll give you a couple of examples from my own experience. Security Magnetics is the first successful company, I should say, that I started. And I was an engineer. I was in my early to mid-20s. And I was in a meeting with some people from the TAB, the predecessor to Tabcorp, when it was state-owned. And I was sitting in that room with them, and they said, we've got a problem. We want to introduce a gaming system. We want it to function without coins. We want it to use a card, and we want that card to be secure. I'm an engineer, so I happen to know a lot about secure card technology at that point in time. And I said, no problem. Just explain to me how you want it to work. They did, and I said, here's the solution. So I figured, left brain, job done. I'm going to get the sale. 20 minutes it took to figure out what they had as a problem, what they needed as a solution. I didn't need to invent anything. It was already invented. I just needed to adapt an existing technology to solve their problem. 20 minutes, job done. 2 years before I got a sale. And that is the difference between left brain, right brain combination value proposition. I had the left brain bit done in 20 minutes. I need to spend 2 years getting the right brain bit done. No statutory authority of a state is going to deal with a 24-year-old with no assets, no company, and not even a fax machine. We needed them back then. No way in the world. I needed to turn myself into a multinational corporation. I needed to do it quickly because they were going to tender. And that's how the 2 years began. Nothing to do with the solution. Another good example of the challenge with value proposition. Catch of the day. Many of you have probably bought products from Catch of the Day. A couple of good friends of mine, Gabby and Kezi Leivovich, they founded the company. It's not my company. They founded it. But I stepped in there to help those guys. And I can guarantee for you, without any shadow of a doubt, they have never sold anything anybody needs. And they'll be the first people to tell you. In fact, if you ask Gabby, the CEO of the company, he says, we sell shit to people who don't need it. That's what he says. I kid you not. That's what he says. They do it very, very well. And why? Because they understand implicitly. It's not like these guys analysed anything, but they're retailers. They implicitly understand it's all about the right brain. And I mentioned fear and greed. Catch of the day is a perfect combination of fear and greed. And it works like this. There's a bargain. It's only available for 24 hours. You want that bargain, there's your greed gland going crazy. Right? I want the laptop for $500. It's $1,000 in the stores. I've got to get that. Right? And I want to be able to say to everyone, I got a laptop for $500. Fear kicks in because it's only available for 24 hours or until stock runs out. So you've got to get in fast. So we set the record in Australia for the most laptops sold in a given period of time. We sold over 2,000 laptops in 2 hours, which is more than all the laptops sold through all of the hardware stores out there, so the JBs and the Harvey Norms and so on, in a day. And we sold it in a couple of hours. Fear and greed. Absolutely nothing to do with whether or not anyone needs the product. Left brain, right brain. That's the combination you're after when you start a new business. But it's not easy. It took me 2 years with my first business. Why is it not easy? Well, while you're trying to figure out the left brain, right brain combination, you're burning cash. It costs money to bid on a tender. It costs money to do a sales pitch. It costs money to hire people to work out the design of your product so that people like the look of it, not just the function of it, because if I don't work on the look of it, no one's going to buy it because it's ugly. It doesn't matter how well it works. So there's all sorts of things that you've got to start doing when you're building a business that are not about necessarily generating cash straight away. So you enter what's called the valley of death. This is where you're burning cash. You only have a limited amount of cash. If you don't start to make money before the cash you have runs out, you die. Valley of death. The area under the curve is how much money you need. The horizontal timeline tells you it's all about time. You've got to move fast. So let's go to our next question for the IML fraternity. If you're building a business, what sort of investor or financing options would you ideally like to have if you had your druthers? If it was entirely up to you. What sort of investor would you have? Would you prefer to take money from family and friends? Would you prefer just debt secured against your house? Would you prefer an angel investor or a high net worth investor? Perhaps a venture capitalist? What about a strategic corporate? What about a big corporation? What sort of investor? And finally, customers. What about just customers and bootstrap the business? Forget the investor class. So, away we go. This is good. Next year they'll tape this so that we can play it back.
What, and get me out of a job? I hope not. 10 seconds.
All right.
Just, we can only choose one.
Yeah, go with your favourite.
5 seconds. 4, 3, 2, closed now.
All right. And the winner is customers. Oh, 40% customers, like you're thinking. And then it goes angel investors. Venture capital didn't do too badly at 20%. Debt, only 8%. No one wants to risk their house. That shows great confidence in your business. It works for me. And friends and family, only 6%. Okay, so let's do a whistle-stop tour through these different asset classes, if you will, and we'll look at some of the pros and cons. Now, for those watching this on tape, if it gets into the wrong hands, this is supposed to be slightly lighthearted, okay? I don't mean everything that I'm about to say all that seriously, but there are some points in here that are worth remembering. So, having protected myself, let's move on.
That's great. I usually apologise after I've said something.
I know I'm going to offend, so it's all right. Okay. All right. Firstly, if you're going to raise money, you have to be inspirational. Now, most of you should recognise this, yes? They're just reforming. Did you hear it on the news? So they're going to be doing a show in London. And they said that there are planets closer to London than Australia, so they're not going to come here. But you have to be inspiring. And that, I say that lightheartedly, but that is so important. If you're going to try and get people to part with their money to support your business, if they don't believe in you, you have no chance. So being inspiring is what it's all about. Whether it's that kind of inspiring or not, I'll leave that for you to figure out. Right, customers. 40% of you said customers was the best way to get money. I have to completely agree with you. The best source of money for any business is a customer. It's non-dilutive. It builds your reputation. There's just no downside to raising money from a customer, unless you sell too soon. If you sell before you're ready and you disappoint a customer, nothing travels faster than bad news. So when you are going to take money from a customer, be sure you understand how to manage the relationship with the customer. Don't be too quick to take their money. Customers will often respect you even more if you don't ask for money until you're ready. But engaging with a customer is crucial. Let's look at another one. Founders, families, and friends. Now, remember, I currently work for the government, so the definition of these 3 Fs has to be sanitised. There is normally another word instead of founders, but we'll leave it for now. These are the people who believe in you despite all evidence to the contrary. All right? There is no way you are investable at the point where you go to your family. They're trusting you, they're investing in you, they're giving you a shot. It's not a bad way to start, and sometimes it's the only way you can start, but what you don't want is to upset your family. It might make Friday night dinners a bit difficult if you blow their money and have nothing to show for it, but it is one good way to at least get started. Angels. People talk about angel investors. It's important to understand what a real angel investor is. A real angel investor is someone who has built a business in your domain, in the area in which you're trying to build a business. They've succeeded. They've made money and they're prepared to invest back in and give other people in the same space a go. They bring more than money. They bring an understanding of how to build a business in that space. They can be your best partner, but it is a partnership. They are not an investor like the bank lending you money against your house. When you do business with an angel investor, you must understand you are buying into a partnership by taking their money. So be sure that you really know that person at the personal level, the human level, because things will get rocky. And when they get rocky and you've got the wrong partnership, your angel turns into something else. Then you've got someone with a lot of money angry with you. Okay? So remember, when you're working with well-heeled partners, it is a partnership, it is a marriage. Make sure you test that partnership before you embed that partnership. Venture capital. This is the least understood asset class in the marketplace. People think they know what venture capital is. Most people don't really understand how it works. Classic venture capital funds are designed around investors providing a manager with money to invest on their behalf to deliver them above market returns. It's an asset class that's greedy by nature. It's prepared to accept a higher risk because it's an illiquid asset, means these are private companies. They can't just be sold on the stock market. They don't have a daily value. So it's illiquid. It's tied up for up to 10 years. The money's tied up for that long. You can't just pull out. So when you put your money with a venture capital manager, you're trusting that they can multiply that money several-fold to give you that above-average return. And to give you an idea of the sort of returns people are expecting, it's sort of 20% year-on-year return is the expectation. Otherwise, why would you take a risk with an illiquid asset when you can put it in the stock market and get pretty much 10 to 12% property similar? The right venture capitalist is going to add a lot of value, just like an angel investor, and they're going to be a fantastic partner in terms of getting good contacts. But remember this, they're running to a timeline. If things start to go wrong, they're going to have to sell out of your business or get out of your business fast. They don't have the same level of patience that you might expect depending on how your business grows. So their timeline is sort of 3 to 5 years from the time they get in, they really want to get out. So it's an interesting kind of marriage. So you get married with a view to divorce. But it's a joyous divorce because you're splitting a lot more than you started with. That's the plan. Now, when it doesn't go right, this is where the mythology of vulture capital comes in. Because a venture capitalist is going to put in protections for themselves and their investors to make sure that they get the first bite of the cherry to get their asset back before you get anything. So if you head down the wrong path with a venture capitalist, you might find yourself with completely misaligned interests. They'll want to get out of the asset, you might want to continue, and it gets a bit awkward. And they will typically sign you up to a whole bunch of terms and conditions which puts the balance of power in their hands when that time comes. So understand what a venture capitalist needs from their fund, understand the timeline of your business, and make sure you can match that timeline with the maturation of your business. If yours is not the sort of business that can grow really quickly in that sort of time frame, don't take money from a venture capitalist. They probably won't invest in you for starters. But if your intention is to run the business longer term, venture capital is really not the sort of investor that you want. Strategic corporates. Strategic corporates is also very little understood, but far more common than venture capital. This is where a company will invest in you. Often a company in the same supply chain that you're trying to operate in. They see strategic value in your business succeeding. They want a piece now. Maybe they want to buy your whole business later. Very, very powerful form of capital because it market makes for you. It doesn't just give you money. But when a little company gets involved with a big company, it doesn't always work out. Right? Because big companies work to a different timeline. If it's a strategic investment, they may not be as focused on the money side of it as you are. They're more interested in the strategic positioning. So again, it's all about really understanding who you're taking money from because it's a partnership. And finally...
Is that your younger brother?
That's my younger brother. That's it. You like the superimposition there? So, government, what do? So you just saw Retimer before come up and talk to you about the glasses. Well, we supported Retimer in the early days when they were just getting that technology out of the university, as they were starting to build that relationship with the auto parts manufacturer that's ended up producing that terrific product. And our role as Commercialisation Australia is to provide funding and expertise by way of contacts to the companies we support in order to get them through the very early stages of that valley of death. So in a sense, we work where the market is least likely to participate. We help the companies get to the next stage so that the commercial marketplace can naturally take over. And Retime is a perfect example of a situation where coming out of the university, it really needed that extra help. They got their strategic investor in the form of that auto parts manufacturer, and the rest is history. They're now a profitable little business, doing some really good stuff with a great technology that's invented in Australia. It's a classic case study of what it is we do with Commercialisation Australia. But we don't take equity. We don't take equity. That means we're not going to get into bun fights with you when down rounds occur and all sorts of complications happen. We know it's difficult. We understand we're investing at a very high risk end of the spectrum. And so when things don't go so well, there's no bad picture. So with that, thank you very much. I will just ask one last question. After I've just gone through all those, I want to ask that second question again to finish. And let's see if any of you have changed your mind after that very brief sojourn. If you had your choice of what sort of investor financing you'd like for your business, what would it be? Start the clock.
Are there fewer options this time?
No.
Same number of options.
Same number of options.
I thought you may have taken away family and friends. It'd be interesting to see if anyone still goes with family and friends.
Yeah.
10 seconds.
Oh, we've got a musical accompaniment now.
8. 5 seconds. 4, 3, 2, 1, and the results. Whoa!
Oh, look
they
at
were
that.
listening.
How compelling was that? Thank you very much, everyone.
Fantastic. Doron Ben-Meir.